Hey VA borrowers, my name is Steve Doherty. I'm the Raleigh VA loan guy. I'm a loan officer in Raleigh, North Carolina, and a United States Marine Corps veteran. Today I want to talk to you about the funding fee on a VA loan and mortgage insurance and how that fits into a VA loan. Namely, our question for today is, do VA loans have mortgage insurance? Let's take a close look. So, does the VA loan have mortgage insurance? Well, not really, especially when you compare it to how mortgage insurance is required on other big mortgage programs like USDA, FHA, and Fannie and Freddie. On those programs, you will pay a monthly mortgage insurance payment, right? As part of your monthly payment, you will pay a certain amount to the mortgage servicer as mortgage insurance. And mortgage insurance, the word implies it is offsetting risk, right? It's protecting the mortgage lender from some kind of outstanding risk. And generally speaking, underwriting guidelines and pricing are kind of built on the premise that the smaller the down payment, the more risk there is to the borrower, or the more risk there is to the lender in case there's a foreclosure. There may not be as much equity to recapture the servicer's loss. So when we think of mortgage insurance as protecting against some kind of risk, does the VA funding fee do that? Well, let's take a look real quick at the VA definition of the funding fee and why they have it. So the VA specifically says the VA funding fee is in place in order to defray the cost of administering the VA loan program. So it's offsetting some kind of cost, right? To me, that really sounds like a form of mortgage insurance, right? They're covering some other kind of cost, whether that cost may be risk of the borrower not paying. But unlike, say, mortgage insurance on most conventional mortgages where you're making a down payment of less than 20%, the VA loan is not going to continually collect that mortgage insurance premium on a monthly basis. You just pay it up front once. So in that sense, the VA funding fee may be similar to mortgage insurance in some respects, but it's not executed the same way as it would be on a different type of mortgage program. So who exactly does pay the funding fee? Do all veterans pay the funding fee? No, and most veterans will end up being exempt from paying the funding fee by virtue of the fact that most veterans, especially of the sort of GWAT vintage, have some kind of disability rating. Now, that's the parlance that you'll hear online. That's what you'll hear from people who are vaguely familiar with VA loans. You need to have a VA disability rating in order to be exempt from the funding fee. But that's not actually precise. It's not the language that the VA regulations use. Technically, in order to be exempt from the funding fee, you need to have a disability rating from the VA, which is compensable. In other words, your disability rating rates you compensation. You get something back from the VA. So that means if you have a disability rating of 0% from the VA, which is possible, you're considered disabled in the eyes of the VA, but your rating is only 0%, you will probably still have to pay the funding fee. The reason for that is at a 0% rating, you're not entitled from any compensation from the VA. So if you have a 0% rating, do not presume that you are not going to have to pay the funding fee. Another class of people who will be exempt from the funding fee are those who are on active duty and have a Purple Heart. Now, it could be possible that you have a Purple Heart, you're a veteran, and you have a 0% disability rating. I would find that pretty hard to believe, but it's possible. So any Purple Heart recipient will also be exempt from the funding fee. This is a this is not a very well-known rule in terms of VA funding fee exemptions. So if you are a Purple Heart recipient, especially if you're on active duty, make sure that you are conveying that to your loan officer and tell them that you are exempt from paying the funding fee. There are a few other categories of exempt people from the funding fee. For instance, if you're a surviving spouse of a veteran who was killed on active duty or died on active duty, killed in combat, or died after active duty service, but their death was connected to a service-related disability, then you would not pay that funding fee as well. So if you're not exempt from the VA funding fee, how much will you have to pay for that funding fee? Well, it varies a little bit depending on if you've used your VA entitlement before and whether or not you're making a down payment and how big of a down payment you're making. So if you are doing 100% financing, meaning you are purchasing a home and you are not making a down payment, and you have not used your VA entitlement before, meaning you've never had a VA mortgage, you will pay a funding fee of 2.15%. So 2.15% of the loan amount, 2.15% of the purchase price if you're doing 100% financing. If you have used your VA entitlement before and you are doing 100% financing, not making a down payment, your funding fee will be 3.3% of the loan amount. If you can make a 5% down payment, you're going to get a little bit of a break on the funding fee. If this is your first time using your VA entitlement, right? You've never had a VA mortgage before, you're putting down 5%. That VA funding fee will go from 2.15% of the loan amount down to 1.5% of the loan amount. And finally, if you're making a 10% down payment on first-time VA entitlement use, your funding fee will only be 1.25% of the loan amount. So you see that you get a pretty big break when you go from 0% down to 5% down, right? The funding fee goes from 2.15 to 1.5. But when you double your down payment from 5% to 10%, it's only decreasing from 1.5% down to 1.25%. So generally speaking, when I have VA borrowers who are interested in making a down payment, right, they just kind of want to lower that loan amount, I will tell them, hey, just a heads up, you're not going to get much of a break by increasing the down payment from 5% to 10%, at least from a funding fee perspective. Another thing to consider is you're probably not going to get a better interest rate by doubling that down payment. So when you buy a home, if you want more cash on hand and you want to reduce that down payment from 10% to 5%, you shouldn't feel too guilty about it. Now, the VA used to have a more complex calculation of the VA funding fee depending on how many times you've used it. And there's a different calculation also if you served in the National Guard or the reserves and did not have any Article 10 active duty time. But now we do it pretty uniformly. So the second way you want to look at this is if this is not your first time use. If it's a second, third, fourth, fifth time use, note that the funding fee will only increase for your subsequent use. It won't keep going up for your third, fourth, and fifth time. But if you are going to if you're not going to make a down payment at all, and you're doing 100% financing, and you've used your VA entitlement before, the funding fee will be 3.3% of the loan amount. So now we're starting to look at pretty big figures, especially if you have a hefty purchase price with a corresponding hefty loan amount. Now, for subsequent use of the VA loan, the funding fee will be the same at 5 and 10% down, regardless whether it's your first time use or subsequent use. And if you want to learn more about whether you should go with a VA loan because maybe you are going to be facing a large funding fee, please check out my other video on that topic, which is if you do have VA entitlement, should you always get a VA loan? Or in other words, does it ever make sense to not go VA? In some cases, if you are going to pay that 3.3% funding fee on a VA loan, there may be some advantage to going conventional. Also, if you're making a 20% down payment or larger on a conventional loan, you will have no mortgage insurance at all, monthly or upfront. There's no mortgage insurance. So if you have to pay a 1.25% funding fee on a VA loan, that will increase your loan amount by 1.25%, where you would not have that corresponding increase in the loan amount on a conventional mortgage. Now, the analysis doesn't stop there. For instance, if the interest rate is a full percent lower on the VA loan, the VA loan will probably still be a better bet, especially if you have a loan amount, say, over $450,000, but it is something to pause and take a look at. So what if you don't have your disability rating yet, but you've started the process? Or maybe you think you will get a disability rating, but you just haven't got around to kind of going through the whole process with the VA on the VA medical side. Well, you could possibly still get your VA funding fee reimbursed to you, right? Refunded, But in order to do this, you have to have your claim put into the VA prior to the closing of your loan. In other words, if you close on your loan on June 1st and you don't have your VA physical until June 5th, and then 30 days later you get a disability rating of 30 or 40%, you're not going to get that VA funding fee refunded to you. You would have to have the VA, the provider, or the nurse or medical professional who does your VA physical and puts you in for a recommended disability rating. Remember, they don't make the decision. They make a recommendation to the VA, and then the VA has the final say. That recommendation would have to be submitted to the VA before you close in order to be eligible for that refund if you do in fact end up getting a disability rating. And remember, that disability rating would have to be more than 0%. So if you're not exempt from that funding fee, how do you pay it? How do you pay that 3.3% or that 2.15%? Do you have to write a check at closing, right? Do you need to pay 3.3% on an $800,000 home? No, you have the option of financing it, and that's what the vast majority of borrowers do. They add it to the loan amount. I've done well over 100 VA loans. I think I've only had one occasion where a borrower wanted to pay cash for that funding fee. It simply gets added to the loan amount. Now, depending on your loan amount and your interest rate, over time, there could be a benefit to electing to pay cash for it, right? If you're reducing your loan amount, you pay less interest over time. But generally speaking, that cash now will be worth more to you than it would be, than the interest savings would be spread out over time. Finally, if you have the option of paying cash for the closing table or financing it, can you split the baby? Can you do, let's say you have $1,000 seller credit left over. In other words, there's a seller credit that couldn't be applied to any more closing costs, prepaids, and escrows. Can you pay cash for some of it and finance the rest? Believe it or not, you can't. And I was really surprised to learn this. The VA does not let you split it. You can't pay cash and finance it. You have to choose one or the other, which means most likely you're probably going to end up financing that funding fee. Again, my name is Steve Doherty. I'm the Raleigh VA loan guy, a loan officer in Raleigh, North Carolina, and a United States Marine Corps veteran. If you have any questions for me about the funding fee, if you are exempt from it or getting that VA disability rating recognized by the VA for mortgage lending purposes, please give me a call. Also, if you'd like me to pre-approve you for a VA mortgage loan, please reach out to me. I'd be more than happy to have a phone call with you, kind of walk you through the whole process and get you pre-approved. Again, I'm Steve Doherty. I'm the Raleigh VA loan guy. Thank you for watching. Please stay tuned for more videos.